Good morning and welcome to today's financial market update. Let's start with the key signals from Wall Street overnight. The three major U.S. stock indexes closed mixed on Friday but with extremely narrow movements. The Nasdaq finished at 26,281.61, essentially unchanged. The S&P 500 closed at 7,575.39, also flat, and the Dow Jones ended at 52,637.01. The market is clearly waiting for a new catalyst. In after-hours trading, futures edged slightly higher, with Nasdaq futures up 0.29%, S&P futures up 0.29%, and Dow futures up 0.36%, sending a faintly positive signal. Looking at individual stocks, there were no verified significant moves yesterday. Among major tech names, Nvidia edged up 0.19%, Tesla gained 0.04%, while the QQQ ETF slipped 0.12%. Cryptocurrency-related stocks came under pressure, with IBIT falling 0.3% and MSTR dropping 0.26%, consistent with the broader decline in Bitcoin and Ethereum, which fell 2.35% and 2.17% respectively. Now turning to the global macro picture. The 10-year U.S. Treasury yield edged up to 4.57%, a gain of 0.13%, indicating that liquidity is not easing further. If yields continue to rise above 4.6%, growth stocks could face renewed valuation pressure. The VIX Volatility Index stood at 16.34, jumping 8.72% in a single day. While still within the normal range of 15 to 25, this is a notable move. If the VIX holds above 16.5 after today's open, it could signal a shift toward defensive positioning. The US dollar index, the DXY, came in at 100.90, down 0.19%, extending the weak dollar trend. A weaker dollar typically supports emerging market assets and risk assets, though current technology trade restrictions may offset this benefit. WTI crude oil fell to $73.86 per barrel, down 1.08%, reflecting ongoing concerns about global demand. Spot gold traded at $4,070 an ounce, essentially flat, suggesting haven demand has not significantly picked up. In summary, the current global market landscape presents a complex mix of a weak dollar, subdued gold prices, and moderate volatility, pointing to cautious sentiment leaning toward risk-off. Now let's look at the renminbi and the external environment for Chinese assets. The renminbi has appreciated modestly recently, with the onshore rate at 6.7650 and the offshore rate at 6.7791. This is a positive signal for foreign capital returning to A shares. However, if the pace of appreciation accelerates too quickly, it may draw regulatory attention. On the trade front, the U.S. Commerce Department announced stricter export controls on semiconductor key materials imported from China, including high-purity quartz and specialty gases, set to take effect in 90 days. This news was the core external factor behind yesterday's sharp decline in the A-share semiconductor sector and continues to weigh on market sentiment today. For today's A-share market open, we expect a lower start. The weekend escalation in technology trade restrictions, combined with the downward momentum from last Friday's sharp sell-off, create significant opening pressure. Let's break down today's market outlook. For the major indices, the Shanghai Composite and the Chi-Next Board are likely to remain weak and volatile. Last Friday, the Shanghai Composite fell 2.06%, while the Chi-Next Board plunged 3.1%, both technically breaking below their 5-day and 10-day moving averages. Despite support from a weak dollar, the technology restriction news will take time to digest. In terms of sector focus, power infrastructure and grid equipment are the most likely sectors to see activity today. Global data center power bottlenecks are raising supply chain concerns, and market attention may shift toward transformers, smart grids, and high-efficiency cooling solutions. The utilities sector also offers defensive value when risk appetite declines. The biggest risk remains in semiconductors and related materials. The U.S. export controls on high-purity quartz and specialty gases directly hurt domestic companies that rely on imports. This sector already suffered heavy losses last Friday, and further downside today is highly probable. Investors holding related positions should carefully review their exposure. As for northbound capital flows, the probability of net inflows versus net outflows today is roughly balanced. A weak renminbi and low VIX typically favor foreign inflows, but sector-specific headwinds from technology restrictions may make foreign investors cautious on tech stocks. The key signal to watch is the direction of northbound flows during the first hour of trading. If net outflows exceed 20 billion yuan, it could indicate a broader risk-off move by foreign capital. To wrap up, our probability assessment for today is 20% for an up move, 40% for a sideways move, and 40% for a down move. Overall, the market is in a weak and volatile consolidation phase. Investors should remain cautious, keep a close eye on further developments regarding technology trade restrictions, and monitor the direction of northbound capital flows for clearer signals.